Prices are still falling even though supply is finally shrinking. Yes, this can happen, and it is happening right now in Toronto. So let's take a deeper look at what actually happened to the market this past November. New listings did fall a bit, but the reality is that sales fell even more. And you can also see that the existing inventory in Toronto continues to pile up, which means homes are actually sitting unsold for longer. So even though there are fewer new listings, the total amount of inventory is still high. And that's why the market continues to feel very weak. And it's a lesson for you not to just look at one number. You have to look at the full picture. A big reason listings fell is because condo sellers are pausing on selling because prices are just not there. Existing condo listings are not selling at all unless the prices are very low. So there's really no point to list right now if they can't get the price they want. Meanwhile, new listings on homes that actually sell in this market, houses are actually still going up. And keep in mind, houses aren't the same across the GTA. The 416 and the 905 are on completely different paths. These suburbs had a bigger COVID run-up, and so they end up having more air to give back. And honestly, they're probably not done yet. Toronto didn't inflate as much as you might think, and so whatever correction left should be a lot smaller and less painful. And inside the 416, semi-detached homes are actually the quiet winners. They're the most stable part of the market, and their sales to new listings ratio is actually closest to normal levels, even in a slow month. And the reason here is actually pretty simple. There is real demand here because semis are the cheapest way for a young family to get into a house in Toronto, and there's also just not enough stock. So if you are trying to figure out where the floor is forming first, this is probably the first segment that leads the recovery. So what does this all mean? Well, first, don't bank on prices rising because of rate cuts. There's really no sign that we're getting more cuts, and even after rates fell from 5% at the peak to right now 2.25%, affordability still didn't improve enough to drive a real rebound. The next stage of this Toronto real estate market won't be about cheap borrowing. It'll be about real end user demand, focus on strong rental income assets, and investors who create value instead of waiting for appreciation only. This actually puts value-add investors in a strong position compared to last year. Prices are softer, sellers are more flexible, and there's far less competition. If you buy well and you add more density, you win twice. You get the renovation lift and you get stronger rents and cash flow. And what this does is it will boost your returns and lower your risk. Here's a simple example. You buy a dated semi for around $900,000. You put about $200,000 to convert it into 3 legal units to get around $2,000 a month in positive cash flow. Plus, once it's done, it's usually worth around $1.3 million based on today's comps. And that is roughly $200,000 in forced value. And because the building now produces stronger rental income, you can refinance, pull out most of your money, and repeat. And this is how investors scale in a flat market. They force their returns. And here at Elevate, this is exactly what we do. We're not just a real estate sales brokerage. We're Toronto Multiplex investors ourselves, so we know what works and can help our clients do the same. We'll help you figure out what's best for your situation and then help you find high potential deals, run the numbers, negotiate strong offers to buy the best deal, and then plan renovations if you need that. And also, if you need it, lease and manage your property too so that it can perform at its highest potential. So if you do want to see how this could work for your situation, just book a free call with us at this link right here, and let's go through your options together.